Hello everyone, welcome back to another Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an equity strategist here at Zacks Investment Research, and today we're talking a little bit about the state of the U.S. healthcare industry. So we're just going to take a quick look at some key macro factors in public policy that affects the industry, as well as we'll take a look at a couple of the top picks that we have in the industry. So let's get started. So healthcare in general, it's a big, broad term, but overall healthcare is one of the few sectors of the economy that is mostly isolated, right? It's mostly isolated from macroeconomic cycles. And by that we mean things like, cycles of production, consumption, interest rates, commodities, and foreign exchange markets. So it's mostly isolated from the ups and downs that the broader economy tends to go through. Once every 10 years or so, we usually end up in a recession. Or if we don't have a recession, we do have a brief downturn, if you will, and that happens once every 5 or 6 years. But healthcare is one of the rare sectors of the economy that never really experiences that kind of volatility. Because it is a critically needed service that is mostly funded for the most part through insurance, either private insurance or through the government's Medicare and Medicaid programs. And so this is an industry that is continuously funded. It's never not funded. And therefore, and because it's a requirement, a necessity of life, it never has the ups and downs that other sectors tend to go through. It's one of the most stable sectors for that reason. But it's also one of the most heavily regulated industries. We'll talk about that in a minute. And here you can see a chart. This is from the Zacks Research System, our flagship equity research software. And this is showing you a chart of the stock price, the average stock price of the healthcare industry, meaning all the companies that are in the S&P 500 healthcare sector. But more importantly, I wanted to show the orange dotted line, which represents the earnings of these companies together as a whole, on average. And you can see that even through recessions, as we saw in 2001 and in 2008 and then in 2020, these companies don't ever go through cycles. They're not prolonged downturns. They're not even temporary downturns. These are companies that continuously grow as long as there is a population. As long as there's a population, and as long as the population grows over time, which is still the case throughout the world, healthcare will continue to do well and to compound earnings per share over time. And that's one of the big draws to this sector. So let's talk about some of the top macro factors that do affect healthcare. Number one, interest rates. Now, I just said, in 2 slides ago that interest rates do not affect healthcare, but by this I mean it impacts valuations on healthcare. Since we are investors, we want to understand valuation, which helps explain a lot of the return that we generate in the market. So although the fundamentals are not impacted by interest rates, remember, many industries are very interest rate sensitive, like home builders, right? When rates rise, it becomes more difficult for people to borrow, and therefore their budgets decline to offset the higher cost of financing. Other industries are also very interest rate sensitive, like the auto industry. Healthcare is not impacted by interest rates. It doesn't matter if there's 1%, if the 10-year yield is at 1% or if it's at 10%, at least not directly. It does not impact fundamentals because it doesn't matter what the interest rate is if you have a heart attack, right? Or if you have an ongoing chronic condition that needs attention. You will still seek the medical care that you need. So it does not impact fundamentals, but it does impact valuations because many healthcare stocks are slow compounders, meaning they do not grow very quickly. They grow very, very slowly, and many parts of healthcare are like that. And as a result of that, these companies are treated like bonds because they are high dividend yielding companies. For example, some of the highest dividend yields in the market are found in healthcare. And so many of these companies are treated like bonds. And so as rates rise, their PE multiples contract and vice versa. So that's an important thing to keep in mind. There's also the regulatory environment. Regulations are, one of the biggest, in fact, the biggest cost. If you had to have any single line item expense, it's more than wages. It's almost as much as R&D is in many cases, if not more than what R&D is, which is the cost of compliance. Also, another important trend is that Medicare reimbursements have been going down gradually, and it's expected to decline another 2.9% this year. And this has been ongoing now for 5 years. It's declined every single year for 5 years, and this is due to budget neutrality requirements. Basically, there's a law that states that as Medicare increases its coverage, for example, in new categories, it needs to offset that increase from some other place. And so they've constantly drawn from reimbursements to physicians in order to pay for the wider range of services that Medicare covers now. So obviously Medicare does get a budget increase every year, but if they have committed capital to new areas of healthcare, then and it goes beyond the budget, then they have to make sure that they cut reimbursement rates for other parts that they do cover. And so that's been kind of coming out of the hands and pockets of physicians these last 5 years. That's been an ongoing trend for Medicare. And also another big tailwind, for example, for healthcare is that the U.S. has consistently experienced an aging population. The median age now in the U.S. is 39.2 years as of 2023. That doesn't sound too old, but that number is gradually increasing. It was at 30 years in 1980, and now we're at 39.2. So this is happening because as boomers age, right, the baby boomers were the largest, segment of the population. And as they are now mostly in retirement by now, combined with a declining birth rate, those two factors together are driving the median age higher and higher over time. So as the population ages and as the population increases, overall the population has been increasing, the need for healthcare is therefore continuously rising. So we use this term healthcare. It's a big monolith, but let's look at what are some of the subsectors and sub-industry groups within healthcare. And remember, healthcare is so large, it represents 18% of U.S. GDP. But within healthcare, we have three primary buckets. We have the drugs and pharma industry, we have medical services, and then we have medical products. These are the three broad industry groups within healthcare. And we know what drugs and pharma are. Those are the large pharmaceutical giants that we have. Then there's medical services. That includes things like nursing homes, hospitals, outpatient care, and even health insurance. And then we have medical products. Those are medical device makers, medical instrumentation makers, dental products, those types of things. We're going to take a look at some of the companies that are key players that we are very bullish on as well in just a minute. But just a note on compliance, the American Hospital Association estimates that the cost of non-clinical compliance, so that basically means the cost of compliance outside of the drug pharma industry. Because when we're talking about clinical compliance, that's obviously the cost of compliance when it comes to running clinical trials to bring a new drug to market. Obviously, the FDA regulates that quite heavily, and that's very, very expensive. But even if you remove that and look at the cost of compliance for the other two industries between medical services and medical products, the total cost of that compliance is $39 billion annually. And many researchers and other commentators have stated that this burden of compliance has had the effect of diverting clinicians away from patient care and towards administrative activities for compliance. So the standard of care, or at least the quality of care, in part, some people argue, has gone down because clinicians who are trained to care for patients end up having to wear other hats, such as being involved in the administrative side of things. This we know for sure is happening at small practices, small medical practices, where combined with the fact that doctors are getting less reimbursements for their services, either in primary care setting or in specialty settings. And so many times, especially at smaller medical practices, we see doctors are reducing the amount of staff that they have to handle administrative medical paperwork, and are often doing those duties themselves. And so that's been a thing that many people have noted, and that is unfortunately projected to continue. This is a little bit different from when we have to think of this in terms of being an investor, but just so you know, these are some of the things that have been ongoing, these broad trends that have been ongoing in the U.S. Healthcare experience. The cost of compliance continues to be a very, very large headwind for the quality of care to go up, and for medical establishments to be able to run an efficient operation. Here's a chart quickly of the three industries that I just mentioned between medical product makers, medical service providers, and the drug industry. And here you can just quickly see very, very quickly, if you look at just the most recent past here, over the last several years, there is quite a separation between the red line, which represents medical product makers, medical device makers, the pink line, which represents the pharmaceutical drug industry, and the green line, which is the medical care or medical service providers. You can see that the PE multiples are very high for these two, or at least a lot higher for these two, right, between medical device makers and drugs, and very low PE multiples assigned to medical service providers. So this tells you right off the bat that the hottest areas of the market within healthcare are in drugs and in medical device makers. But in the medical service providers world, it's very, very not happening. As one would say, there's not a lot of excitement in that aspect of the industry. So if I go back to this chart here, medical services includes things like nursing homes, hospitals, health insurance. So investors have really voted that this part of the market of healthcare is not only low growth, but it's also very high cost of compliance. It's also much lower margins compared to the other two. And that's why you see that these companies are, therefore assigned a much lower PE multiple, significantly cheaper than the market average at under 15 times forward earnings. Whereas the drug industry and the medical device industry, that's where the growth is at, and that's where the margins are at as well. And so that's the area of healthcare that has added the most amount of shareholder value over the past many years, drugs and medical device makers. So when formulating an investment strategy, I would, generally speaking, allocate more towards those two industries and a little bit less towards medical services. However, there are some very, very exceptional members of the medical services industry group, and we'll take a look at a couple of them on who they are. And not to say that we should avoid that industry entirely, But what I'm trying to say is we should be very selective on who we pick from that industry. So first and foremost, if you're building a healthcare investment strategy, I would really focus on these two areas of the sector: drugs and pharmaceuticals, as well as medical device makers. And then within this area, I would not buy a blanket ETF that covers all of them. I would be very selective on picking individual stocks that are standouts, and we'll take a look at exactly who they are, or at least just two specific companies. So let's take a look at that. So here on the next chart are some of the top Zacks rated stocks in healthcare. So on the drug side, we have AbbVie, Gilead, and Vertex. On the medical services side, again, this is the area that's a little bit less happening, lower growth, higher cost of compliance, lower margins. However, there are a couple of companies in here that can add significant shareholder value because of how incredible their execution continues to be year in and year out. We have Cencora, Universal Health Services, Cardinal Health. And then on the medical product side, two big standouts, Boston Scientific and Insulet. These are just 8 companies that are, I believe, that I've personally handpicked that are, top rated according to the Zacks indicator rank, but also have very strong prospects for growth. So let's take a look at each of these 8 briefly here. We have AbbVie first, right? AbbVie, everyone knows of this company. It's the top play in immunology. Their big claim to fame was Humira. That was their blockbuster $10 billion plus dollar drug. But they've also developed and commercialized Skyrizi and Rinvoq. This area represents 60% of their revenue. AbbVie also has a strong presence in neuroscience and oncology. They've made strategic acquisitions, and they have a very promising pipeline to advance even deeper in neuroscience and immunology. Remember, the big problem with AbbVie for the last couple years has been that their top drug, Humira, has been coming off patent as of 2023. And so shares have been really under a lot of pressure because of that threat. But at this point, AbbVie has proven an ability to shift, to pivot away from dependence on Humira by bringing forth and commercializing very successfully these other drugs in immunology, namely Skyrizi and Rinvoq. You may have seen their commercials, on TV. But this execution has been stellar. And so that's prompted very strong positive EPS estimate revisions from analysts. So momentum remains very strong. So we're very bullish on AbbVie over the next 5 to 10 years. Gilead, a very similar situation, but in a different area. This is the top play in virology, oncology, inflammatory diseases. Remember, they came out with their big hepatitis C drug roughly 10 years ago. But they were kind of a victim of their own success because Sovaldi was, so good at solving hepatitis C, they basically rid the world of hepatitis C. So once everybody was cured, there was not much more to do, or not much more left to generate in terms of revenue. So this, shares have been really muted for 10 years. However, it's coming alive now. They have really built their reputation now on its HIV business, again in virology, with their blockbuster drug Biktarvy. That delivered $13 billion in sales last year. That was a 13% increase year over year. This is a very stable and predictable revenue source and profit stream. And here's the big reason why we're bullish. They're taking the same drug, Biktarvy, which is already FDA approved, but are running 7 parallel clinical trials in order to get a wider label for that drug. This is very attractive for investors, especially because they're already taking an FDA-approved drug that is proven to be safe, and they're just running trials to prove its efficacy in 7 more indications. So remember, the first time around, it's very slow and expensive, but once you've gotten a drug approved, it becomes a lot quicker and therefore a lot cheaper to prove its efficacy in other areas as well. And so this is a very cost-effective way, a low capex, much lower R&D route to generate more revenue. And so we have potentially seven more indications coming for Biktarvy over the next 10 years, and that's going to basically guarantee the company's dominant position in HIV with a very long runway for growth because of what they have in the pipeline. So again, we're very bullish on Gilead. Vertex, this is the top play in cystic fibrosis. Vertex is probably the fastest growing among large cap pharma. They've been, just absolutely stellar in the execution in helping, deal with this terrible lung disease, right? Cystic fibrosis. And they've gotten a very strong pipeline spanning multiple therapeutic areas. Trikafta is their number one drug that generated $2.7 billion just last quarter alone. That was a 17% growth rate year over year. They're working on expanding indications, again, very bullish for margins. And they're pushing into new geographic regions to add up to 10,000 new eligible patients, a total addressable market of 94,000 patients suffering from cystic fibrosis. So, the growth runway is very, very long. And Vertex holds a dominant lead. So these three companies are top picks within the drugs and pharmaceutical sector, and they each are extremely dominant in their respective areas. So we're very bullish on these three. Highly recommend that. Cencora, these are two companies that we picked within the medical services area. Cencora, Universal Health Services, and Cardinal Health. I kind of grouped Cencora and Cardinal Health together because these two together are both very large drug wholesaler and distributors in the United States. This is an interesting industry because it's basically an oligopoly where three companies, basically Cencora, Cardinal Health, and a third company called McKesson, they together supply 90% of all prescription drugs in the U.S. So they add a lot of value because they remove the sort of the hassle of, for drug developers and manufacturers to have to deal with all of the myriad of processes to get their drugs into the hands of the end users, right? The individual retail pharmacies, as well as hospital pharmacies and other areas where patients end up getting the drug, right, for final consumption. So they handle the entire, they handle the entire process of dealing with drugs, getting them into the hands of the end consumer, the patients, by providing those last mile services as well as buying these drugs wholesale from the manufacturers. So they, maintain over 50 distribution centers, 50,000 managed products. They provide service to 100,000 plus locations, 16 million deliveries annually. The sheer scale that they operate in, it creates a wide moat and a stable and very predictable revenue stream. Cencora is an exceptional company within this area here. We're also bullish on Universal Health Services. This is a company that operates 27 hospitals, more specifically inpatient acute care hospitals. That's what we normally think of when we think of hospitals. And they operate 333 behavioral health facilities, 40 outpatient care facilities. And also an interesting thing about them, they also have an in-house insurance and physician network. So that's something that's unique about them. They provide both primary care and specialty physicians within their network. They also have in-house insurance. So it's kind of a diversified and vertically integrated business model. And people were skeptical whether it'd work, but they have now proven with remarkable earnings growth over the last 4 or 5 years that this business model can work. So it's unlocked tremendous value. The shares have performed really well. But in just their most recent 6 months or so, the stock has really come back in terms of having a typical, correction as shares typically do, and they just traded 10 times forward earnings, despite the fact that analysts have significantly revised up the earnings outlook for this year and next year. So we think that this is a tremendous opportunity to own a very high quality company trading for a very attractive price. And two picks that we have within the medical products area, Boston Scientific and Insulet Corporation. Boston Scientific is a spectacular company. It's a top play in the medical technology area. They specialize in two segments, cardiology and what they call med-surg. In cardiology, they make things like aortic valves. They make electrophysiology devices. They make atrial appendage closure devices. So cardiologists and cardiothoracic surgeons, highly depend on these cutting-edge technologies that Boston Scientific comes out with for resolving, multiple different types of cardiological issues. They also, make surgical equipment that's used in endoscopy, urology, and neuroscience. And the company has now proven an ability to pivot to these high-growth areas. And they've created significantly more shareholder value than their competitors. So it's important to know, why are we picking Boston Scientific? Because there are other medical device manufacturers that are their competitors, namely Becton Dickinson and Medtronic. But that's why it's very important when you're picking stocks, you want companies that not only exhibit and demonstrate an ability to grow at a high rate, but you also want capital efficiency too. Companies can make big acquisitions to show growth, but if the price that they paid was very high, then the return on investment that shareholders get is very low. So growth is great, but we want to see growth with capital efficiency at the same time. And Boston Scientific has not only gotten better, generated better growth by showing that they have this ability to pivot to these high growth areas within surgical technology, but they're doing it cost effectively too, with better returns on invested capital versus Becton Dickinson and Medtronic. So we're very, very bullish on Boston Scientific. Insulet Corporation, another specialty medical device maker. They are one of the key innovators of insulin delivery. So typically what has to happen is diabetics that need to self-administer insulin, they, have to repetitively inject themselves with insulin. And that leads to complications. Quite often it leads to sometimes people forgetting to give themselves their dose on time. Sometimes they don't do it properly. Sometimes they give the incorrect dosage. Things can happen. Mistakes can happen, right? Whereas Insulet, they've created a very innovative little patch. It's a tubeless insulin pump technology. And all patients have to do is wear this little pump, and it continuously supplies insulin when needed, and it's completely autonomous. So you never have to worry about it. You don't have to think about it. Once you put it on, you don't have to worry about it after that. So that greatly expands convenience and increased efficacy. It eliminates error and other complications that come from that. And patients have really overwhelmingly adopted their solution. Product sales have surpassed $2 billion in 2024, and that's good for 22% growth year over year. And they have a very attractive business model, right? It's a razor blade model where it's basically recurring revenue. Patients have to continuously purchase, the replacement pods that goes into this, and these are very attractive margins at 65 to 70%. And from a competitive standpoint, their Omnipod 5 is the first and only automated insulin delivery system, that's approved for both type 1 and type 2 diabetes. So very, very bullish on Insulet as well. So overall, healthcare remains a top area for investment. It's a recession-resistant industry. It will continue to see very long-term secular growth as populations rise and age together. But I would say we should remain selective to generate strong returns as investors, because the regulatory burden and declining reimbursements remain a pretty big headwind for many companies. So I would be very careful as to which companies you pick. So the general guideline that I would say to follow when picking stocks in general, but especially in healthcare, is number one, look for companies with a strong Zacks indicator rank. This is a quantitative model that measures the strength of earnings estimate revisions. It is available to clients that have a subscription to the Zacks Advisor tools or the Zacks Research System software. So look for companies with a strong Zacks indicator rank. Search for companies with strong growth prospects. Always ask the why. Why should they grow? Are they a leader in their respective industry? And do they have products that have a long growth runway? These are some of the qualitative questions you should be asking. And then number three, very, very important, I talk about this a lot, return on invested capital. Capital efficiency matters, but it's very underrated. Nobody ever talks about it, but it really matters for long-term shareholder returns, because we want growth at a high level of capital efficiency. That's the twin engine of strong returns for investors. And then we look at forward PE. We just want to make sure that we're not overpaying for companies. So don't buy companies that are reaching towards 2 standard deviations above the average, unless if there's a very, very, very good reason to do it. But look for reasonable PE multiples, but with strong growth and ROIC as well. So hope this was helpful to everybody. If you have any questions, please do reach out again. You can reach us at 1-866-794-6065 or send us an email to strategycall@zackspro.com. All right, thanks everybody, and talk to you soon.